Stop what you're doing. Close the other tabs. This is not a video you half watch while checking your phone. What I'm about to walk through requires your full attention, because by the time this becomes front page news, the trade will already be over. I need you to hold one number in your mind for the next 20 minutes. That number is 8.2. It's a ratio. It represents the relationship between paper silver contracts and deliverable physical silver in major exchange warehouses. 8.2 claims for every single ounce that actually exists. We'll come back to that. There's a quiet signal moving through the mining sector right now that nobody is talking about. Silver miners, specifically the junior and mid-tier producers, are trading at valuations that make no mechanical sense. Not undervalued in the usual beaten-down sector waiting for rotation way. Undervalued in a way that suggests active suppression. The kind of pricing that happens when someone needs the price not to move. Here's what I mean. When silver moves from $18 to $23 per ounce over a 6-month period, you'd expect the miners with leverage to that underlying commodity to outperform. That's the whole point of owning them. But that's not what happened. The metal moved, the miners didn't. In some cases, they moved in the opposite direction. That's not market inefficiency. That's not retail selling. That's a bid being systematically removed. The surface explanation you'll hear is simple. Higher energy costs, rising labor expenses, geopolitical risk in key jurisdictions, all true, all insufficient. Because those same pressures existed 18 months ago when these stocks traded 40% higher on lower silver prices, the math doesn't reconcile. And when the math doesn't reconcile, you look for the incentive. This is what I'm going to walk you through today. Not whether silver is going up or down, not whether you should own miners. I'm going to show you the architecture of suppression, why it exists, who benefits, and the very specific mechanical failure point that ends it. By the end of this, you'll understand exactly what's being protected and what happens when that protection fails. Stay with me. I spent years in environments where the question was, what should the price be? But what does the price need to be for this structure to survive? Those are different questions. The first one is about value. The second one is about stability. And in precious metals, particularly silver, the second question has dominated for decades. Think of it like a dam. The natural water level wants to rise. It's fed by rivers, by rainfall, by snowmelt. But the dam holds it back, keeps the downstream town from flooding. The dam isn't evil. It serves a function. But the dam also requires maintenance. It requires structural integrity. And it requires that the water level never exceed what the dam can hold. The moment that happens, everything downstream changes in minutes, not months. Silver is that water. The dam is the paper market structure. And the downstream town is a set of institutions whose balance sheets cannot survive a disorderly price discovery. Here's the story you'll be told when this finally breaks. You'll hear that silver prices rose due to industrial demand from solar panels and electronics. You'll hear about electric vehicle battery requirements. You'll hear about investment demand returning as inflation expectations shift. All of this will be true, and none of it will be the actual reason. The actual reason is that the short position concentrated in a small number of institutions has reached a size that cannot be unwound without moving the price in a direction that triggers margin failures. This is not speculation. This is visible in the commitment of traders data if you know how to read the commercial short concentration. 4 or fewer traders hold a net short position equivalent to 140 days of global mine production. Not 4 categories of traders, 4 actual trading entities. Hold that. To understand why this matters, you need to understand how the silver market actually functions at the plumbing level. There are 2 markets for silver. There's the paper market, where futures contracts trade on exchanges like COMEX. And there's the physical market, where actual metal changes hands between refiners, industrial users, mints, and dealers. In theory, these 2 markets are connected by arbitrage. If the futures price gets too far from the physical price, someone will buy one and sell the other until they converge. That's how it's supposed to work. That's how it worked for decades. That's not how it works now. The arbitrage mechanism requires 3 things. It requires available physical metal to deliver against paper contracts. It requires market makers willing to take the other side of large positions. And it requires capital to fund the carry between purchase and delivery. All 3 of those requirements are now impaired. The physical metal is increasingly not where it needs to be. Exchange warehouse inventories have declined by over 300 million ounces since 2021. The metal didn't disappear. It moved. It moved to vaults in Switzerland, to sovereign reserves in Asia, to industrial supply chains that don't want to rely on just-in-time delivery. The ounces that remain in exchange warehouses are increasingly spoken for, allocated to specific holders who have no intention of selling. Registered versus eligible inventory ratios are at historic extremes. This is where the 8.2 ratio comes from, and that number is getting worse, not better. The market makers who would normally absorb order flow and provide liquidity are pulling back. They're pulling back because the risk reward has shifted. When you make markets in a commodity, you're essentially renting out your balance sheet. You buy when others want to sell, you sell when others want to buy, and you make money on the spread. But if the underlying position moves against you faster than you can hedge, you lose money. And the volatility signature in silver has changed. The moves are faster, the gaps are larger, and the depth of book has thinned. Market making in silver has become a losing proposition for all but the most capitalized participants. And even they are reducing exposure. The third piece, the funding, is where it gets structural. Post-2008 bank capital regulations changed how commodity positions are treated on balance sheets. A short silver position that used to require minimal capital now consumes significant regulatory capital. The cost of holding that position has gone up, way up. And that cost gets passed through in the form of wider spreads, less liquidity, and an increased incentive to manage price rather than facilitate discovery. This is where the suppression mechanism lives, not in a room where people decide to push a button. In a set of institutional constraints where the least costly path is to prevent the price from moving. Here's the critical point. The assumption that underpins the entire structure is that paper claims and physical metal are interchangeable, that if you own a futures contract, you can always convert it to metal, that if you need to deliver metal against a short, you can always source it. That assumption held for 40 years. It no longer clears. The last 3 delivery cycles on COMEX showed something that shouldn't happen in a functional market. Delivery notices exceeded available registered inventory. The exchange had to reach into eligible inventory, which is metal that isn't formally available for delivery to satisfy obligations. This is the mechanical equivalent of a bank dipping into customer deposits to cover its own obligations. It works until customers ask for their money. Let me walk you through what a stress scenario looks like in this structure. Start with baseline conditions. Silver is trading at $23. Open interest in futures represents approximately 800 million ounces of paper claims. Registered warehouse inventory is roughly 100 million ounces. Most contracts roll forward before delivery. The system functions because participation in delivery remains low. 92% of contracts close before first notice day. The physical market and the paper market coexist in a state of managed separation. Now change one variable. A sovereign buyer, let's say an Asian central bank or a state-affiliated industrial reserve, decides to take delivery of 20 million ounces over a single quarter. Not to trade, to hold. This isn't a large position in the context of paper markets. It's approximately 2% of open interest, but it's 20% of registered inventory. And it doesn't roll, it stands for delivery. The exchange has a problem. It needs to source metal that isn't readily available. The first 10 million ounces come from eligible inventory, metal that holders haven't explicitly made available, but that can be incentivized to move with premium payments. The next 5 million ounces come from the London market, via exchange for physical transactions that effectively outsource the delivery obligation. The final 5 million ounces don't come. They get settled in cash at a premium. The premium gets reported, and the market notices. This is where it turns. Once the market notices that paper and physical are no longer interchangeable, behavior changes. Holders of futures who previously would have rolled forward now stand for delivery because they're not sure they'll be able to get metal later. Industrial users who previously bought on a just-in-time basis start building inventory because supply chain risk just became real. And the short sellers who have been rolling positions forward for years suddenly face counterparties who want metal, not paper. The feedback loop has a specific structure. Higher delivery demand depletes inventory. Depleted inventory makes the next delivery cycle harder. Harder delivery cycles increase the incentive to take delivery early, and each cycle accelerates the next. Think of it like a crowd in a theater. If one person stands up to leave, nothing happens. If 10 people stand up, the people behind them can't see. If 50 people move toward the exits, the people still seated start wondering if they should move too. And if someone yells fire, everyone moves at once. The exits are the same size they always were, but the demand to get through them just overwhelmed capacity. The silver market's exits are the delivery mechanisms. They were sized for normal traffic. They cannot handle a rush. Here's what makes this different from a normal commodity squeeze. In most commodities, high prices solve supply problems. If copper gets expensive, mines ramp production, recyclers process more scrap, users substitute alternatives. The market finds a new equilibrium. Silver doesn't work that way. 70% of silver production comes as a byproduct of copper, lead, and zinc mining. Silver miners don't decide how much silver to produce. Copper miners do. And copper miners make that decision based on copper prices, not silver prices. If silver doubles, primary silver production increases modestly. Byproduct production doesn't change at all. This is the inelasticity problem. Silver supply cannot respond to silver prices in the short term. It takes 7 to 10 years to bring a new primary silver deposit into production. That's after discovery, after permitting, after construction. The mines that will produce silver in 2030 are already being built or have already failed to get built. There's no supply cavalry. Now layer in the demand reality. Solar panel manufacturing consumed 140 million ounces last year. That number is growing at 20% annually. By 2027, solar alone consumes more silver than total mine supply. Not more than available silver, more than all the silver that comes out of the ground. And solar is one industry. Electronics, medical, water purification, batteries, and investment demand all compete for the same supply. This is where the math stops working. At current prices, the structural deficit between supply and demand is approximately 150 million ounces per year. That deficit gets filled by drawing down above-ground stockpiles, inventories in London, in COMEX warehouses, in ETFs, and sovereign reserves. But those inventories are finite, and they're declining faster than they're being replenished. The institutions that are short silver are not stupid. They can see this math. They've seen it for years. And they've responded by suppressing the price because that's the only way to extend the timeline. Every month that silver stays at $23 instead of moving to $35 is a month that paper positions can be rolled, that delivery obligations can be delayed, that the reckoning gets pushed forward. But suppression has a cost. The cost is that the eventual adjustment becomes larger. The longer price is held below the level that would clear the market, the larger the deficit grows, the more inventory gets depleted, and the more violent the eventual correction. This is not about manipulation in the conspiracy sense. This is about institutional incentives creating an outcome that no individual participant can stop. The traders managing these short books aren't villains. They are operators facing a set of constraints, where the only viable strategy is to keep doing what they've been doing until they can't. The question is, when they can't. Let me give you 3 scenarios. Scenario 1, managed continuation. The current structure holds for another 12 to 18 months. Inventories continue to decline but remain sufficient to meet delivery obligations. Industrial users don't panic buy. Investment demand stays muted. The price grinds slowly higher, allowing short positions to be covered incrementally without dislocating the market. I give this about a 20% probability, not because it's impossible, but because it requires every variable to cooperate simultaneously, and markets rarely cooperate. Scenario 2, disorderly failure. A delivery failure occurs on a major exchange. A significant buyer stands for delivery and cannot be satisfied with available metal. The exchange invokes force majeure, settling contracts in cash at a premium that reveals the true price of physical silver is significantly higher than the paper price. This triggers a cascade of delivery demands as holders rush to convert paper to metal before they can't. Mining stocks that have been suppressed suddenly reprice to reflect the new reality. But the move is violent, gap-filled, and nearly impossible to participate in unless you're already positioned. I give this about 35% probability, skewed toward the next 18 months. Scenario 3, controlled reset. Regulators and exchanges, recognizing the instability, implement position limits that force large shorts to cover over a defined timeline. The price moves higher in a controlled manner. Physical premiums normalize. Mining equities appreciate to reflect improved fundamentals. This is the soft landing. It requires coordination between exchanges, regulators, and the institutions holding the short positions. It's the best outcome for system stability, but it requires the very participants who benefit from the current structure to accept losses voluntarily. I give this about 45% probability, but only because the alternative is worse for everyone involved. Here's what this means if you're trying to make sense of your own positioning. The mining stocks that have been suppressed are not suppressed randomly. They're suppressed because their prices are derivatives of an underlying commodity whose price is itself being managed. If you own silver miners and wonder why they don't track the metal, this is why. The metal price you see quoted is not the price that would clear a free market. It's the price that exists under a set of constraints designed to prevent disruptive discovery. When those constraints fail, the miners don't catch up gradually. They reprice in days what should have taken years. The appropriate framing is not when will silver go up, but what is the signal that suppression is failing? Those are different questions. Here are the indicators to watch. First, the COMEX registered inventory level. When this drops below 75 million ounces, the delivery mechanism is under severe stress. We're at roughly 96 million now. The trend is your friend until it isn't. Second, the spread between futures prices and physical dealer premiums. And when you can buy a paper contract at $23, but dealers are charging $3 over spot for physical coins and bars. The arbitrage link is broken. Track this spread. It's telling you something the futures price isn't. Third, exchange for physical volumes. EFP transactions allow participants to swap COMEX positions for London positions. When this volume spikes, it often indicates that someone is trying to satisfy delivery obligations by reaching outside the domestic warehouse system. It's a stress indicator. Fourth, large trader position changes in the commitment of traders report. Specifically, watch for declines in commercial short concentration. If the 4 largest shorts start covering, they know something you don't. Fifth, lease rates. Silver leasing is how metal moves between holders who have it and holders who need it. When lease rates spike, available metal is scarce. This is an early warning indicator that often leads delivery stress by 60 to 90 days. None of these indicators will make headlines. None of them will be on financial television. They live in weekly reports and dealer conversations and the unglamorous plumbing of commodity markets. But they're the actual signals, not the price. Let me zoom out. What's happening in silver is a specific instance of a broader phenomenon. The paper claim architectures built over the last 40 years assumed that physical delivery was optional, that most participants would always prefer cash settlement, that the underlying assets would always be available if someone actually wanted them. That assumption is being tested across commodity markets, across bond markets, across collateral chains. Silver is early. It is not alone. The institutional response to this has been consistent. Manage the price, control the narrative, delay the reckoning. This works until it doesn't, and when it stops working, the adjustment is proportional to the delay. The question is not whether the math reconciles. The math stopped reconciling years ago. The question is how long institutions can manage a structure that is fundamentally unstable. And the answer, historically, is longer than you expect, but shorter than they need. The silver miners are being suppressed because the price of the metal they produce is being managed. And the price of the metal is being managed because the short position against it has become too large to unwind. And the short position became too large because for decades, paper claims substituted for physical metal in a way that felt like it worked until it didn't. This is not conspiracy. This is accounting. The entries have been made. The obligations exist. The metal does not. Something resolves that gap. The only variable is when and how disorderly the resolution. The mining equities, trading at valuations that made sense when silver was $12, are telling you something. They're telling you that the market is priced in suppression, continuing indefinitely. That's a crowded assumption. And crowded assumptions, when they break, don't break gently. So watch the indicators, understand the structure, and recognize that the question was never if. The question was always how long.